A global market sell-off kicked off the week, and frankly, that's putting it lightly. It was the biggest sell-off in decades. Japan's Nikkei started things off dropping 12%. It was the index's worst day since 1987's Black Monday crash. Then, the rest of the world followed. The Dow Jones Industrial Average dropped more than 1,000 points, making even the most casual observers stop and take notice. And yes, cryptocurrencies also got bludgeoned. The world's 500 wealthiest people lost a combined total of $134 billion. And yet, as sobering as all that is, to keep listing the bad news, ultimately, what does it mean for investors and businesses both large and small, and what does it mean for those on the outskirts? I'm Cody Combs, and on this edition of Business Extra, we look at one of the most turbulent days for the global economy in quite some time, and we speak with someone who's seen the good, the bad, and the ugly of the world economy. It's Faisal Hasan, a CIO and head of asset management at Al Capital. Without further ado, and amid the hangover from the bad day on the global markets, joining me now is Faisal Hasan, based out of Dubai. Faisal, thanks so much for joining us.
Great to be on the show. Thank you very much for inviting me.
Absolutely. Obviously, we should point out this is a very fluid situation. We've had a little bit of time to digest what happened, but what do you make of Monday's sell-off?
I think the Monday sell-off was a result of the negative, let's say, the job news that came from the US. The market was sort of looking at some kind of a decline in economic activity, and we have been sort of vacillating between soft landing and hard landing. And the job numbers that came out, that gave an indication that probably we are going towards a decline in the economic situation, and that led to across the board selling on the markets. Then we saw not even the mega tech, which were on the decline mode, if you see it in the last few weeks, but it became much more across the board selling across the markets.
Now, just listening to your measured approach to this, I know I feel better. And maybe it's just your personality, but I have to ask, for someone who's as seasoned as experienced as yourself, when you see this drop, like something that happened on Monday, what's going through your mind at something like this in real time? Like, what are you thinking? What kind of thoughts are you processing?
First thing is you have to believe in your portfolio. If your portfolio is well diversified, yes, you try to put in a bit of the cash and see whether there are opportunities, because you have to see whether this decline is going to continue or whether this is a buy the dip opportunity. If you have a high conviction on the portfolio, again, this thing probably won't matter if you look at it from the 5-year horizon. We have seen the markets decline in the last few years many times during the COVID, and they came back. But yes, overall, we have to see where the economy is looking like. And if you have a good portfolio, I think you should continue to stay. Yes, with this kind of decline, that gives you opportunity to churn the portfolio. And that's about it.
So, if I'm hearing you correctly, it doesn't look like you are forecasting a recession anytime soon, or correct me if I'm wrong.
We are looking, but again, we have to look at the numbers that has come in. So in the last, let's say, few months, we have seen some numbers good, some numbers bad. We have seen the inflation come down, which was the Fed, which is the US central bank's main theme. Inflation has come down. We have seen some of the numbers not looking good. And the job numbers that came, which the market was not expecting, that led to the decline in the equity markets. But yes, we are looking at, because that the situation of the US central bank is to contain the inflation and to maintain the growth. So it's a very fine balance, and they have been doing a good work recently, and they are looking at the data by data. So last year were expecting 5 rate cuts this year, which did not happen till now. And it's a matter of the interest rates that markets are expecting a rate cut. And now with the yesterday's decline in the markets, people were asking for the emergency rate cut and all. Not sure whether Fed will do that, because the numbers, they want to go on, let's say, month by month numbers, especially on the inflation, especially on the job markets, before they do, because their credibility is at stake.
What does an impending interest rate cut mean for the personal finances of all those listening to this podcast?
In our part of the world also, because we are pegged to the US dollar, and in US also, the main impact on the rate cut is on your the interest expenses that you pay on the mortgage or your personal finance. and that you have more money in the hand, so your EMI goes down if you are on a floating rate. And even on the corporate sector, because most of them are on the floating rate, when the rate cut gives them room for growth, so that adds, and then money moves from, let's say, the fixed income instrument, which are yielding very good, to the higher risky and other asset classes. So we see sort of rotation from the fixed income to the equities.
What has the fallout been in the Middle East? Who's been hit the hardest by Monday's big fall off?
You can say all the stocks were down, and there was a bit of a panic selling where we saw the stocks going down. But yes, the mid caps and the small caps, which have less sort of liquidity, they go down more. But overall, I think, and as we speak, the markets are coming back. But yes, we saw across the board selling because market participants wants to get out of the market, have more dry powder in the hand because they see that the volatility is going to continue, and they should have a bit of cash in their hand so that they can buy it at lower levels.
What about your haven assets, your government debt, your gold? What's happening with that right now?
Gold has again and again has given the performance that it is a hedge. And I always look at the debate between, let's say, crypto or the bitcoins and the gold as an hedge. And yesterday was a very good example. The crypto was down, the Bitcoin or Ethereum was down like 14-15%, whereas gold was flat, if or little down or little up. So gold has been a hedge, and that's why precious metal should be a small part of the portfolio as a hedging mechanism. And I think again yesterday gold proved that it is a good hedge, and there should be an allocation to gold as an asset class.
I wasn't going to focus on it too much, but since you brought it up, I'd like to inquire, is this a game changer for cryptocurrencies, or is this just your normal volatility that we've seen time and time again?
I think this is a normal volatility. We should, as an investor, we should be ready to accept that either the cryptos or even the equities as an asset classes are much more volatile. There will be volatility periods, and especially we expect the second half of this year to be much more volatile as there are many uncertain events that are coming up. We are looking at the interest rate cuts, whether it will happen, how much it will happen. Then there is a elections in US, so that uncertainty also has an impact on especially the US markets and in general the overall markets and the asset classes. So there are a lot of uncertainty which is there in the second half, which will make the equities and the cryptos a volatile asset class.
When this was all happening yesterday, there's obviously a lot of rumors and a lot of conjecture that some people know what they're talking about, other people don't. But one thing we kept seeing, at least in various social media circles, was that some people speculated that, okay, this means that the AI tech bubble is finally bursting. Now, is there any truth to that whatsoever? Does that play any role in this? Or what are your thoughts?
No, I think first of all, we have to look at that AI is here to stay, and we are a firm believer of AI. And the kind of growth that still people are expecting is more linear in fashion, where AI is expected to be more exponential because it's going to affect every part of our lives. And right now, the beneficiaries of AI has been more of the hardware, the kind of NVIDIA's, and that has stretch their valuation because that's the first beneficiary of the AI. But then I'm sure there'll be other industries and other companies that will be beneficiary. Yes, the valuations on the specific, let's say, chip stocks or AI was looking at a bit of, let's say, stretch. But if you look at the earnings growth, the earnings that they were showing was much higher than the other sectors or other parts of the economy.
Yeah, I want our listeners to keep in mind we're recording this on Tuesday, and right now, at least as of the current market conditions, things are looking up a bit. But in your opinion, sir, what should we expect in the days and weeks ahead? Are we going to look back on this and it's like, oh, this was much ado about nothing, or is there's something to this?
No, as I said earlier, I think we expect, especially the second half, it's going to be much volatile. There are many economic numbers that are going to come up in the next couple of months, which will dictate which directions does the US central bank, the Fed, take. So we are talking about inflation numbers, we are talking about job numbers, we are talking about retail sales. And on the other hand, there are geopolitical considerations that are there across the world, and there are elections in US which is going to sort of affect the industries that one party or the other party sort of prefers. So there's a lot of moving parts that are going to be in the play in the next second half. And one thing is for sure that it will be a volatile period.
Okay, so fueling this is the fear that the US Central Bank and the Federal Reserve was behind the curve in terms of cutting interest rates. Where do you personally fall in that argument?
I think the both the bond markets and the equity markets were expecting a rate cut. But again, the economic data and the Fed has been sort of measured in their approach. But still, we believe that probably, if not an emergency rate cut, because I think Fed should not be dictated by the market. But if the economic conditions go in the way, we expect a rate cut in September and probably in December.
I think it's safe to say that everyone would agree that yesterday the general public did panic a little bit. But does anything about the way this is covered in the media frustrate you at all? Somebody who's an expert such as you say, oh, well, this is, I just can't believe they keep reporting it like this. Does anything frustrate you when you see something like this unfold?
I think yes, because probably it's a bit of a what you call sensationalization that if the market goes down by let's say 3-4%, it's an Armageddon scenario, and then it goes up, so everything is back up. Yes, there are days in a year where the markets go down significantly, and there are days in which there's a euphoria in the market where the market goes up, and that's all the part of the market behavior. But if we look at the long run, I think this all settles down as a sort of a good growth in the market. We are still of the believer that equities provide a very good risk-adjusted returns. But yes, it is expected and it should be expected by investors that there'll be days of upsides and downsides significant in their investment journey.
That precipitous fall off that we all saw on Monday, this all happened amid the backdrop of ratcheting up conflicts in the Middle East, causing a whole other set of nerves to be frayed. How does all the conflict in the Middle East right now, Israel, Iran, the lack of a ceasefire in Gaza, how is that weighing on Middle East markets?
Geopolitics always have a bearing on the Middle East market, especially on two asset classes. One is the energy markets and one is on the financial markets. So you have to look at from the, let's say, foreign investors' point of view that they are looking at the region, which is things are geopolitically not right. But if you look at it from the GCC and UAE, it is quite a safe haven, and we are seeing a lot of foreign investors investing in all the asset classes here, whether you are looking at the real estate, whether you're looking at equities, and this safe haven is attracting investors. And our peg to the dollar also helps because the international investors do not face the currency risk that they face in other emerging markets.
Faisal, is there anything else about this that I'm not asking that you want people to know?
Yes, it will be volatile. I think things will go. It's better to have the portfolio diversified, invest in the companies which have a very good financial structure, financial flexibility, a good dividend paying companies. And then you have to sit back and see what is your risk return profile and how do you allocate to different asset classes. Have a very good diversified portfolio. It always works out in the long run.
Faisal Hasan, thanks so much for joining us.
Thank you very much, Cody.
That's a wrap for this episode. Thanks so much for listening. This podcast was produced by Arthur Edison and Doa Fareed. I'm your host, future editor Cody Combs. And just a reminder to subscribe to us on Apple Podcasts or Spotify so you can get the latest Business Extra episodes as soon as they come out.